previous time we talked about the importance of the PE. This time we will see cases that it fails. We already know that the lower the PE, the lower we pay for the current earnings of a company. The problem is that earnings do not stay the same and that they evolve through the years. They can shrink or they can grow. In the previous video, you remember we were talking about a cafe that was earning 10,000 per year. So if we were paying 70,000 to acquire it, we would get our money back in 7 years, as you see here. But what if this cafe was having declining earnings, if the earnings were declining 20% per year? In this case, you'll see that we won't get our money back over this 7-year period. We'll get just 31,000, and if the earnings won't grow after this point, it will be very difficult to get our money back. It's not a good idea to buy with a multiple of 7 if we have shrinking earnings. Equally, if the cafe was increasing the earnings 20% per year, we see that in 7 years we'll get 150,000. So even if we paid 150,000, 15 times current earnings, we will get our money back in 7 years. So you see that sometimes a higher P is justified for a growing company. If somebody bought Google in 2010, he was paying around 30 times those earnings. Google was earning about 6.5 billion and he will give 200 billion. Then the earnings grew fast to about 35 billion. So even if he paid 30 times earnings here, in terms of future earnings, he paid a much smaller multiple. That shows that the higher P is justified for a company that grows its earnings. Because of that, you hear this narrative everywhere, that companies with high growth, they deserve a higher P, and companies with lower growth deserve a lower P. And because academia believes that markets are efficient, they believe that high P stocks are companies with growth and low P stocks are companies with no growth. I disagree with that. First, I don't believe that markets are always efficient, and second, there are many other factors that can make P irrelevant. A main factor is cyclicality. Some businesses, for reasons that I won't explain right now, have some good and some bad years. In the upcycle, investors see the growing earnings and the revenue, and they believe and confuse those companies as companies with great prospects and growth and revenues, great revenues and net income. And during the down cycle, they think that they are bad businesses with no prospects, with losses, which is wrong because this is the nature of those businesses. And because of that, we have some crazy stuff going with P and cyclicals. Again, we'll use Finbox. We will see a true example. It's Canfor Pulp, and this company is cyclical because it sells pulp and the price of the pulp changes. So you see here we have bad years, good years, bad years, good years in terms of revenue and net income. Bad years, good years, bad years, good years, bad years. What is crazy here is that during the good period, you see, the stock price is very high, but because earnings are inflated, the P here is low, lower than 10. And here that you have a bad period and the stock is cheap, the P is high because the earnings are low. The P is higher here than here. This is unfair to base the company's valuation in those low earnings. Think here that the company has no earnings at all. The right thing to do with cyclicals is to smooth those results. So I will use this amount of earnings, these normalized earnings. In a similar way, sometimes earnings can get affected by exceptional items, that they are one-off and they won't recur in the future. So most of the time we should exclude them in our calculation. Here we use again Finbox and we see Walmart. The net income is the red line after taxes. But here we can see the earnings before taxes, including those unusual items and excluding those unusual items. It's not the same of losing some money for a year than losing money for every year. However, we have some companies that they can abuse exceptional items. Here we see another stock, Vodafone. For many years they have unusual items. So those unusual items, they are not so unusual. In that case, I would include them in a way. I would smooth them through the years, but I would include them. Vodafone probably it's a loss-making business and not a profitable business. A really important factor is the quality of the earnings. When you own a company and this company earns money, you expect to get this value in two ways. One is that the company distributes those earnings as dividends and you get them in your pocket. And the other is that it retains them and reinvests them so the future earnings can grow. But what if they retain the earnings, they reinvest, but not in an efficient way, and earnings won't grow? So it's like those earnings get disappeared. Or what if they just keep a pile of cash? In some occasions, you can also have manipulation of earnings. So it says, I have created value because I have created more inventories, but those inventories can be fake. And even if they are not fake, they might hide inefficiency. If half of earnings are fake and you see a P of 10, then actually you pay a P of 20 because the real earnings are half. Here we have GM. If we go before the Corona crisis, we see earnings of almost 10 billion. And at some point, the market cap was as low as 50 billion. Their P was close to 6, which is very low. But if we check carefully, we will see that the cash flows are negative. So they were not getting the money from their customers. I don't say that earnings here are fake, but it seems that they are low quality earnings. A crucial factor is debt. You find a great company and you pay just 10 times earnings. But if it has high debt, it will be difficult to offer you high dividends because it will have to pay back the debt. And then if you have difficult conditions, it can get bust. Here you see Harley Davidson. They have a very low PE, but the debt to equity is almost close to 500%, and the net debt to EBITDA is 10 times. And that explains that a great company has such a low PE. PE can be totally irrelevant when we have marginal earnings. There is a business that has a revenue of 100 million, but is very close to break even. So for a year it can have 1 million earnings and the other year 1 million loss. But what if for a year they have 100,000 earnings, just 100,000 earnings, and they trade in the stock market for 10 million? It doesn't mean that they are expensive, that they trade 100 times earnings and they are expensive, because those earnings are nonsensical. The value of this business should be based on its prospects of turning around. And it's not about current earnings. Those current earnings are marginal. I ran a screen to highlight that. I screened for companies with crazy high P's. Here we find Papa John's, which has a very high P. And if we go and see, the green line is the revenue, the purple line is earnings, and you see that earnings are really marginal, they are very low. So I'm not saying that it is expensive or not. Maybe it's quite expensive because a company close to break even, maybe it should trade below revenue, 50% of revenue, 30% of revenue, and they trade above revenue. But you can't say that this company has a P of 2000, so it is expensive. Here, P is totally irrelevant. It is based on marginal earnings. So when you see marginal earnings or companies close to break even, P is nonsensical. Jeremy from Financial Education too has fallen to this trap. Financial Education is one of the most famous channels about the stock market. Sometimes I find what Jeremy says very interesting, but this time I think that he has fallen to this trap. So he was presenting some expensive companies. He highlights this crazy P for Shopify. Of course, the price to sales shows a very probably expensive stock if they don't grow that much. But the P of 3000 doesn't say anything here because it is based on marginal earnings. And Jeremy is wrong here. Earnings can also be nonsensical when you have something else with great value. So we have a company that has 100 million of cash and 100 million of property. So it has some value of 200 million. And then it has a small revenue and a small net income of just 1 million. If it trades for 50 million, actually it's cheap, it's not expensive because it has a P of 50. In this case, like in the previous one of marginal earnings, earnings are not the primary driver of value. Finally, there are other qualitative factors that are not always reflected on financials. It can be risks, prospects, efficiency, bad management. Here we have Ferexpo, and you see that the P is close to 2, which is really cheap. But you see the basic narrative that low P is non-growth and high P is growth is flawed. And I can find you many more occasions that P fails and combinations of those. Investing is not a process that a stock with a low P beats the stock with a higher P, or a process that a stock with 5 ticks beats a stock with just 3 ticks. You have to make a story because all those factors get interconnected. As I said in the previous video, you shouldn't forget that you buy a business. What would you do with a cafe? You will try to make a simulation. You will try to visualize how the business will evolve. The same you should do about public companies. Knowing what you buy and what price you pay always matters. Unfortunately, the P is not sufficient for that. What is important to keep is the mindset that P implies. Investing is about what you pay compared to what you will get. Don't forget to subscribe to the channel and like the video. See you.